Hey folks, how are you? This is Tom Smith. Why don't we go ahead and get started? Thanks for joining us for another TradeMONSTER educational webinar. One of our most frequent guests that we have is trading champion Chuck Hughes with us today. And before we introduce Chuck, Chuck has gone over multiple different webinars regarding his strategies. And today he's going to be covering part 2 of two-part strategies that he started in January. If you go back, you should be able to see mytrademonster.com. MyTradeMONSTER.com on the right-hand side has our webinars archived. In the month of January here, you can see the circle is part 1 of Chuck's two-part series, and today we're going to be going through part 2. So for those of you that didn't get to join in on part 1, you can go ahead and it's a little bit of a refresher course, if you will, to see what's going on. I know Chuck's going to cover over very briefly the beginning of that webinar, but again, you can go back and check this out. Otherwise, if you have questions for us, feel free to contact us at mytrademonster.com. We do have the archives here, and please check back frequently to see what upcoming webinars we do have. Why don't we go ahead and introduce you to our guest today? It's Chuck Hughes. Chuck, are you with us?
Yes. Can you hear me, Tom?
Chuck, you sound great. Thank you very much for coming back and doing another webinar with us. I'm going to go ahead and hand the reins over to you, Chuck, and let's get this thing started.
Okay, great. Yeah, thanks, Tom. Thanks, everybody.
It's coming over now, Chuck.
Okay.
Okay, we have you live.
Okay, great. I'm going to switch over to slideshow here.
Perfect.
Okay, good afternoon, everybody. This is Chuck Hughes. It's great to be here today. Thank you, Tom, for setting this up. I really enjoy these educational webinars, and we started a webinar last month where I wanted to present 2 strategies that are working well this year, and we only got to finish the first strategy. So today we're going to look at the second strategy, and in the current market environment, we have kind of a new market reality. We have very slow economic growth, lower corporate earnings, lower stock returns. The S&P's only returned, actually it's had a minus return over the last 13 years and a slightly minus return over the last 5 years. We have high unemployment, a lack of high-paying jobs and decreased job security, lots of price swings with little trend in the markets, and we have a lower standard of living in a slow growth environment. So I'm going to present the second of those 2 strategies that's working in this type of environment. And I've been trading for over 28 years, so I've seen a lot of different types of markets, and this is generally a slow growth market, so you have to adapt your strategies to whatever the market's giving you. And over the last several years, I'm going to just show some examples of price charts of the S&P 500 index over the last 3 years. And what these charts have in common is a lot of price volatility and very little trend. And that's the hand we were dealt with this market. Here's a snapshot from 2012, and you can see a lot of price volatility here, but the index virtually unchanged. Here's another example in 2011. Again, lots of price swings, very little trend, and the index virtually unchanged over this period of time. Here's 2010, same type of scenario, 2011, and the S&P in 2011 was actually unchanged for the year. Started the year at 1257, ended the year at 1257, and this was a snapshot that I took in July of 2012 over the previous year, over the previous 12 months, and again, a lot of price volatility. Here's a more recent snapshot of the S&P. Again, more price volatility, with not a really strong trend either way, and the index virtually unchanged. So that's the type of market environment we're in, and I wanted to present these two strategies that are doing well in this current market environment. And those two strategies are the covered call strategy using both monthly options and weekly options. And the second strategy that we're going to go into detail today is what I call the super portfolio, and these are stocks that do well in a slow growth environment, and that's what we're focused on this year. And I'm very actively trading these two strategies, and I took a snapshot a few days ago, and I currently have $340,000 in actual profits trading these two strategies and an average return of 54%. So these are doing well despite the current market conditions, and I trade these two strategies in two of my retirement accounts. Here's a snapshot of the first retirement account, and I have $254,000 in open trade profits. And this is the stock portion of that portfolio. Here's the option portion. And in this portfolio, I have covered calls, both monthly and weekly covered calls, and I have super portfolio stocks. So this account had, when I took the snapshot, $254,000 actual profits. Here's a snapshot of my second retirement account, and that has $86,000 in actual profits. So just wanted to show you that these are working in real time and have been doing well in this type of market environment. So the economic uncertainty has been keeping the market from trending over the last several years. The Eurozone debt crisis is entering its fourth year with no apparent solution. The U.S. national debt is topped $16 trillion, and the U.S. and global economic growth has been very slow. So let's just recap the covered call strategy that we presented last month, and I just want to go through that quickly in case you didn't see that webinar. But I want to show you an example of a covered call trade that I took recently, and this was for the small cap ETF, symbol TNA. And when I initiated this covered call, I bought the TNA ETF, and then I sold a LEAPS call option. And what that allowed me to do was to purchase this small cap ETF at a 30% discount to its current price. And with these covered calls, the call option that you sell profits if the price of the ETF decreases. So you're essentially setting up a spread here, and the call option profits if the price of the ETF goes down. And it also profits from the time decay of the short option. And this covered call trade can profit if the price of the underlying stock or ETF increases, remains flat, or even decreases. So in this particular example, this ETF provides downside protection because I bought it at a 30% discount. A small increase in the stock price would result in a 53% return for this particular trade. A flat ETF price would result in a 42% return, and a 20% decline in the ETF would result in a 14% return. And of course, the risk is limited to the cost of the trade. So this is an ideal strategy for non-trending markets. And here's an example of that trade, that particular trade, and I bought 400 shares of the small cap ETF at 51.22 and sold 4 of the 55 strike LEAPS options at 15.32. So here's a brokerage confirmation of that trade that we're discussing. And what I did is I did a covered call analysis on this trade, and again, this covered call calculator will calculate the profit potential for this trade based on changes in the price of the ETF at option expiration. And in this example, we went from a 10% increase in the price of the ETF to a 20% decline in the price of the ETF. And this will calculate the profit potential. And again, if the ETF increases 10%, I get a 53% return. If the ETF remains flat, then I get a 42% return. And even if it decreases 20%, I still get a 14% return. So this is a great strategy for any type of market, really. And what I did was I contrasted this covered call strategy with an option purchase strategy. And what I did is I assumed that instead of selling that call option at 55 strike at 1532, in this analysis, I assumed I bought that option. In other words, I bought the 55 strike call, and I paid 1532 for it. And at the time I made that covered call trade, the underlying ETF was trading at 5122. So here's an analysis of an option purchase as opposed to selling the call. And you can see with this analysis, if TNA increases 10% at option expiration, this option purchase would have a 91% loss. If TNA remains flat, it has a 100% loss, and if TNA decreases 20%, it has a 100% loss. So this just contrasts the difference between buying an option and selling the option. So these covered calls with 30% downside protection can profit in any type of market. And I noticed in my covered call portfolio, in the big down days like we had yesterday, my covered call portfolio didn't decline as much because those short call options yesterday profited as the market went down. So there's less volatility in your portfolio because you have spreads on that have the short option portion of that spread profiting as the market goes down. And the other big advantage of this type of spread trade is that you can hold these positions during volatile price swings or wide price swings without getting stopped out like you would with an option purchase. So a lot of advantages to this type of strategy. So again, just to recap, by selling the call, you become, in effect, you become the bank, because when you sell that call, you're taking cash into your brokerage account. So in this type of market, you want to be the bank. In other words, you're collecting the cash into your account instead of paying the cash out to purchase that option. So again, if with the covered call, if TNA increases, we get a nice return, 53%. If it remains flat, we get a 42% return. And even if it decreases, we get if it decreases 20%, we still realize a return versus heavy losses for that option purchase if the TNA is flat or goes down in price. You would experience 100% loss. So I just wanted to review this strategy real quick. This is a great strategy in this type of market. And this covered call strategy has produced over $1.1 million in real-time profits over the last 3 years. And I'll just quickly show you my retirement accounts profit-loss reports with these covered call trades in the portfolio. And they show over $1.1 million in actual profits over the past 3 years. And this was during a very volatile, non-trending type market conditions. And So these real-time results demonstrate, the ability of this covered call strategy to deliver excellent returns despite difficult market conditions. So,
can I ask a question for you?
Yeah.
I know that you have a very diversified product line within your portfolios, including the IRAs. Due to the market volatility and some of the economic negatives that you had mentioned earlier in the presentation, have you found that it's better suited for yourself to start allocating more assets to a strategy such as a covered call, from an example like pulling a little more of your percentages from naked options, or do you tend to stick with your strategies moving forward through the market variations?
Yeah, that's a great question. How do you allocate your funds in this type of market environment? And I have a small portion of my retirement accounts in the option purchase strategy, and but I have the vast majority in the covered call type trades. So I just found that there's less volatility in the profit flow, if you will, and the covered calls are just, you can sleep better at night with these covered calls, and you're not going to get stopped out as quick as if you purchase an option, and these have a lot of downside protection. So I allocate most of my funds to this covered call strategy, because it really can work in just about any type of market environment. And I'm going to show you some examples of weekly covered calls, and they started trading weekly options several years ago, and as soon as I heard about weekly options, a light went off, and I said, boy, that's a great chance to generate weekly income by selling covered calls. And with the weekly options, of course, you get to roll over these covered calls 52 times a year, so it can be a great source of income. And in my portfolio, I allocate about 50% of my covered call portfolios to the weekly options and about 50% to the monthly options. So the weekly options, that's a very lucrative strategy, and because you get to sell option premiums so many times during the course of a year, so that can generate a big cash-on-cash return over the course of the year, and I've been taking advantage of that the last several years. And I'll show you an example here. Here's an example of a weekly covered call. This is actually on the same TNA ETF, the small cap ETF. And what I do is I own the TNA, and then each week I'll roll out of the call option that's expiring and then sell the new call option. As a matter of fact, I did that today, and I rolled out of my short calls on TNA because they had very little time premium left, and then I went ahead and sold the March 1st weekly call, which expires a week from tomorrow. So here's an example. Each week, this is a typical example of how I roll these weekly call options over, and this is an example of an actual spread trade that I put in to roll over. This was from the November 30th calls to the November 30th. So November 23rd calls to the November 30th. So I closed out the weekly November 23rd and then sold the open November 30th. So I do this each week, and it's been working out really well. Here's an example of my fill for that particular spread trade, and I was able to sell 8 of the November 30th weekly calls at $142 or $142 per contract, and that was with the TNA at the time trading at 54.27 by selling the 54.5 strike. That was a at the money strike, and options lose all of their time value at option expiration. So if I sell a weekly call option, and in this case it had 1.42 points of time value, at option expiration in a week, that time value decays to zero. And if I'm short that option, that becomes profit 1 week later, regardless of the price movement of the underlying stock or ETF. So, as an example, that particular covered call, if you were to initiate it on the day that I did the rollover, now I already owned it, so I did a rollover. But if you were to purchase the TNA at the 54.27 and then sell the option at 1.42, 100 shares would have cost $5,285. So to initiate that covered call in that day. Now let's just assume that each week I was able to get a similar premium. Well, over the course of a year, I could generate $7,384 in cash received into my account. And if I have a $5,285 investment, we're talking about 139% potential cash-on-cash return every year. So even if the underlying stock declines substantially, I still have the potential to receive a great return if I'm getting 139% cash-on-cash return by selling these weekly call options. So a lot can go wrong with this trade and this weekly covered call, and you're still going to profit. When you receive a 139% cash-on-cash return, if the underlying ETF or stock declines substantially, you can still profit. If you had bad timing when you first entered the trade, you could still profit. So a lot can go wrong with this strategy, and you're still going to be profitable after a year. You could have volatile price swings in the underlying stock or ETF. You could still profit. So this gives this weekly covered call strategy a big advantage over a stock or option purchase strategy, directional trade. So if you purchase a stock or option, it has to the stock or ETF has to move in the right direction in order for you to profit. But with these covered calls, the ETF could actually go down and you could still profit. So this is a big advantage over directional trades. Okay, let's switch to our second strategy that's doing well in this current market environment, and that's the super portfolio strategy. And to select super portfolio stocks, I use technical analysis. I call it Prime Trade Select. So I have technical indicators that help me select the stocks and options with the best profit potential. And I also use fundamental analysis because we want to buy those stocks that or those companies that are still doing well in a slow growth environment. So this can give you an edge when you're purchasing a stock or an option on a stock. If you do this fundamental analysis and find out which companies are still doing well in a slow growth environment, and then combine it with the technical analysis, and that's been working real well and has enabled me to find those stocks that do well in the current market environment. So the Prime Trade Select technical indicators, there's three indicators, there's three steps that we use. Step one is to determine the price trend and the buying pressure. Step two is to confirm the price trend and determine the extent of that buying or selling pressure and isolate the very best profit opportunities. And step 3 is to select an entry point. So in step 1 of Prime Trade Select, we use a trend following system to determine the price trend. And with trend following, I've been using this for 28 years. And the goal is to quantitatively measure the buying and selling pressure of a stock. And this allows us to follow the trend instead of trying to predict where the trend's going. And we're using a mechanical system instead of using emotional decision making. So there's a lot of advantages to system trading, and I've used the same basic trend following system for many years. So that's step 1. And what I use is I use daily price charts to determine the price trend, and I use the 50-day exponential moving average in relation to the 100-day EMA. And if the 50-day EMA is above the 100-day EMA, that stock or ETF is on a buy signal. And if the 50-day EMA is below the 100-day EMA, then that stock or ETF is on a sell signal. And here's an example. This is the daily price chart for Apple. And this blue line right here is the 50-day EMA. The red line is the 100-day EMA. So we can see back in April, the 50-day EMA crossed above the 100-day EMA. So now Apple stock was on a buy signal, and the trend was up. So we're following the trend with these trend following systems. And as long as that 50-day EMA remains above the 100-day EMA, then the stock is on a buy signal. And here's an example of a sell signal. This was for Merck stock, and we can see right here the 50-day EMA crossed below the 100-day EMA. So at that point, Merck was on a sell signal. So that's the first step in our technical analysis. And I was actually able to do historical results based on this 100-day EMA system. And because it's a rule-based system, you can do this historical testing. So I tested the system over a 24-year period. And what I did is I calculated in this column, the cost to buy 100 shares of each of these stocks in the left-hand column during the first buy signal. So to purchase 100 shares of these stocks, the total cost was $8,204. And over the course of 24 years, the profit on this $8,204 investment was $210,000. So a really good return, and that led to a total return of about 2,567%, and that averages out to about 100% a year in historical testing, the historical return. So the system's done well over long periods of time, and it's when you look at these price charts, it gives you an instant picture of whether you should be buying or selling the stock. So this is a great tool. First step in your process, you want to make sure that the price trend is up, and you simply want to follow the price trend. And you can download these 50 and 100-day EMA lines easily on stockcharts.com. There's a lot of financial websites that will allow you to download the 50 and 100-day EMA. So again, it gives you an instant picture of whether you should be buying or selling a stock. And I've been using this trend following system for about more than 28 years now. And I started with a $4,600 trading account, and within my first 2 years, I made over $460,000 in actual profit. So these are just copies of my Schedule D for those first 2 years. And starting with a $4,600 account using this basic trend system, I made over $460,000 in actual profits. And this was mostly from option trading, stock options. And I've also used this same system many times in the International Trading Championship, and I was able to have 7 first-place finishes and a couple second and third place finishes.
Chuck, third place? Third place? What happened there, buddy?
Yeah, I was slipping. So I'm not trying to brag, but I just want to show everybody that this basic trend following systems had a long history of profitability. Okay, step 2 of our 3-step technical process is we want to confirm the price trend. On any given day, you could have hundreds of stocks that are on a buy signal with a 50-day EMA above the 100-day EMA. So what we want to do is we want to narrow that list down to the best profit opportunity. So what we do in step 2 is we confirm the price trend, and that enables us to find the very best stocks. And one of the trend confirmation indicators I like to use is on-balance volume. And the on-balance volume indicator measures volume flow, and it does that with a simple, easy-to-read line. I'll show you an example of that. And volume flow precedes price movement and helps sustain the trend. So you want to take a peek at how what the volume flow is for a stock, just to see if that upward price trend can be sustained. And the way this unbalanced volume line is calculated is when a stock closes up, volume is added to the line, and when a stock closes down for the day, volume is subtracted from the line. So a cumulative total of these additions and subtractions form the OBV line. And here's an example of it. The OBV line, the top part of this chart is the daily price movement here of Apple, and the lower chart here is the OBV line for this time period. And we simply want to see this line, the OBV line, sloping up. The actual numerical value of the indicator is not that important. We simply want to see this OBV line sloping up, and that confirms the price uptrend. So when we have an upsloping OBV line, volume is heavier on days that a stock closes up, and volume is lighter on days a stock closes down. And it's an indication that the buying pressure is exceeding the selling pressure, and that volume flow helps sustain the price uptrend. And another confirming indicator I like to use is the new 52-week high list. And stocks that make a new 52-week high are in a very powerful uptrend, and they tend to continue with the price uptrend. So I like to focus on stocks that have an upsloping on balance volume line, and also are making a series of new 52-week highs. And in my trading experience, I discovered that stocks that are making these new 52-week highs, they tend to continue the price uptrend, and it allows us to confirm that price uptrend. And this allows us to further narrow down that list to the stocks with the best profit potential. So the stocks that are included in the new 52-week high list represent the very best profit opportunities out there. Plain and simple, a stock does not make this list unless it's in a very powerful uptrend. And here's another example of Apple stock. Top chart is the daily price movement of Apple stock, and we can see it's making a series of new 52-week highs. So that's a confirming price indicator, confirming trend indicator, We can see the 50-day EMA is above the 100-day EMA, and the fact that the stock is making a new series of 52-week highs confirms that price trend, and we have further confirmation with an upsloping unbalanced volume line. And here's an example. This the new 52-week high list can be easily downloaded from barchart.com. And here's an example of the 52-week high list for the day that I took this snapshot. So here's some recent examples of Prime Trade Select Steps 1 and 2. And this is an example for Discover Financial Services. We can see that the stock is making a series of new 52-week highs. The 50-day EMA, the blue line here, is above the 100-day, and we have an upsloping unbalanced volume line. Here's another example. This is for Home Depot. Again, we have the stock making a series of new 52-week highs, confirming the price trend, and we have a further confirmation with an upsloping unbalanced volume line. Here's one more example. This is for Visa, and again, we have the price trend up. The 50-day EMA is above the 100-day EMA, making a series of new 52-week highs in an upsloping unbalanced volume line. So step 3 in our 3-step technical analysis is selecting an entry point, and obviously this is a very important part of the process. And I found over time that the best way to select an optimum entry is to use the Keltner Channels. And the Keltner Channels were developed by Chester Keltner, and they can help us time our trade entry and exit points. And they also provide high probability buy and sell signals. They can also be used to help us select option strike prices, and also allows us to select stocks with repetitive and predictive price patterns. And I'll show you some examples of that here in a minute. So the Keltner Channels, there's 3 channels. There's the upper channel, which is the line, this line right here. The middle channel is the dotted line right here, and then we have the lower channel. And then we have these channels that overlay the daily price movement of the stock. And they basically act as overbought, oversold indicators. And of course, when we want to enter a long position, whether it's a stock or an option, we want to wait till the stock retraces a little bit and pulls back before we enter our trade. And if you do that, you're going to have a higher probability of success. And you don't want to buy when the stock becomes overbought. And when the stock gets near the upper channel, or even trades above the upper channel, then it's becoming overbought. Here's an example where it became overbought, retraced, overbought, retraced, overbought, retraced. So you don't want to buy, obviously, when the stock is trading near the upper channel. You want to buy when the stock is trading near the middle or the lower channel. And these Keltner channels are calculated is the upper and lower channels are 2 times the average true range of the past 10 days, and they're drawn at equal distance from the central line. And the central line, the dotted line, is the 20-day EMA average. So we have the 20-day EMA, which is the dotted line, and then the upper channel is 2 times the average true range over the past 10 days, and also the lower channel is 2 times the average true range. So it's drawn on each side of that 20-day EMA. So that's how the Keltner channels are calculated, and it's a great tool to help you enter and exit trades. So again, you don't want to buy when the stock is trading near the upper channel. You want to wait till it retraces towards the middle or the lower channel. And what I did in this price chart, this is a price chart for Apple stock, and this top table here shows actual trades that I made purchasing Apple stock. This was around the $200 range when Apple was trading at $200. And what I did is I used the Keltner channels to help me time these entries. And the trade confirmation here shows the date that I bought the stock, the number of shares, and the price that I paid. And then what I did was, for these actual trades that I took, in the bottom chart here, I circled the day that I made these trades. And so that gives you an idea of how I use these Keltner channels to help me time my entries. So you can see on each of these, once I purchased the stock, it was trading down towards the middle or lower channel, and that gave me a higher probability of success that that trade's going to work out because the stock was becoming oversold. So you can see with each of these three trades that the stock really didn't retrace very much from my buy point. So this enabled me to select low-risk buy points, and it's a very useful tool. And in this case, I bought the stock around the $200 level. So great timing indicator when to enter a trade. And one of the other uses of the Keltner channels is it allows you to focus on stocks that have a repetitive and predictive price pattern rather than a stock that's all over the place as far as the price pattern. And here's an example. The top chart here is TJX. That's one of the super portfolio stocks that I own. And you can see it has a very repetitive price pattern. When it gets overbought and it gets up near the upper channel, you can see that it retraces to the middle channel, and very predictable price pattern. So I'd much rather trade TJX than Mosaic, where you have a series of uptrends and downtrends, but no real clear trend. And you can get pretty chopped up if you're trading a stock like this. If you're taking a directional trade in Mosaic, whether you're buying the stock or you're buying an option, with this kind of price movement, why trade this stock when you can trade this stock? So that's another great use for these Keltner channels. They help us find stocks with repetitive and predictive price patterns. Here's another example. This is for Sherwin-Williams. This is another super portfolio stock that I own. And again, you can see very repetitive price patterns for Sherwin-Williams. And the lower chart here is for Freeport-McMoRan. And again, you can see some really volatile price moves, no clear trend. So I'd much rather trade these stocks that are very repetitive and predictive. Here's one more example. This is for Disney versus Potash. So I like to focus on this type of a stock with a repetitive price pattern. So now let's talk about the fundamental analysis we do on these super portfolio stocks. We just looked at the three-step technical analysis. Now we'll look at the fundamental analysis. And what we look for in these super portfolio stocks, first of all, they're in a confirmed price uptrend and they meet the criteria of prime trade select. And then we also like to focus on stocks that have little or no correlation to the European economies and debt crisis. And we like to focus on stocks that are not the dependent on the price of oil or commodities in this type of deflationary environment. So we like to focus on stocks that aren't dependent on commodities or the price of oil. And I like to focus on companies that have strong dividend, equity, revenue, and retained earnings growth despite the slow-growing U.S. economy. So we look for stocks that are still growing in this slow-growth environment. And we also like to focus on stocks that pay a dividend, which can act as a floor in during market corrections. So we're basically trying to find stocks that still have strong growth rates, fundamental growth rates in either their dividends, equity, revenue, or retained earnings, despite the slow-growing U.S. economy. So this gives us an edge in our analysis in picking stocks that have the best profit potential. And
so, Chuck, I don't mean to interrupt you, but the super portfolio sounds like you have both a quantitative and qualitative aspect to the super portfolio. You're just not jumping into Keltner Channels. You're looking at fundamentals as well.
Yes, exactly. Yeah, the Keltner Channels is step 3 of the technical analysis, and then once we get step 1, 2, and 3 accomplished with the technical analysis, then we also want to look at the fundamentals for that company too, and this can give us a real edge in this slow growth environment. So we're picking stocks that are not only technically sound but fundamentally sound, and this has given us a real big advantage over the last several years in this type of market environment. So let's look at an example of a super portfolio stock. In this example, we're going to use TJX. It's in a confirmed price uptrend. TJX is the company that owns Marshalls and TJ Maxx stores and home goods. So this company has little correlation to the European debt crisis. It's not dependent on the price of oil or commodities in this deflationary environment. TJX has strong equity and retained earnings growth rates despite the slow-growing U.S. economy, and TJX pays a dividend. So that would be an example of a company that has good fundamentals for the current market environment. And I have about $79,000 in open trade profits for TJX stock. And this is just showing you my open trade profits in my portfolio. I just took a snapshot recently of the portfolio, and these are my 2 retirement accounts, account 1 and account 2. And when I took the snapshot, I had a $79,000 open trade profit for TJX. So what I did is I calculated my super portfolio results over the last several years, and in my stock portfolios I had over $1.5 million in profits. In my option purchase portfolios I had over $1.8 million in profits for these super portfolio stocks. And I'm just going to run through my brokerage account statements real quick. This is for the stock portfolios, and again, that had over $1.5 million in profits in the stock portfolios, average return of 28.9%, 113 winning trades, no losing trades. And here's the first snapshot of our portfolio. In this particular one, I had $143,000 in profits, average return of 30%. And I'll just run through these stock portfolios fairly quickly here. This one had $41,000 in profits. Okay, and let's just look at Yeah.
I'm sorry. Regarding the options, et cetera, and the profits are great. What would you say to clients that are now going to implement this new specific strategy, which are obviously showing you a nice profit, that have been down in the dumps? Perhaps they've had a losing year. What kind of advice would you give to them regarding these strategies on how to start and maybe proceed going forward?
Yeah, that's a good question. A lot of people are in that situation, and depending on your risk tolerance, I would allocate most of my funds to the covered call strategy, and then a smaller portion of those funds, and I would divide it up maybe equally between the super portfolio stocks and options on super portfolio stocks. So let's say you dedicated 70% of your funds to covered calls, then maybe dedicate another 15% to super portfolio stocks and another 15% to super portfolio options. So depending on your risk tolerance, that percentage could change. You may want to have just 50% in covered calls and then 50% in these super portfolio stocks and options. So I would get with Tom and just go over your risk tolerance and your goals, and set up a percentage for each of these portfolios that you're comfortable with. And I'll just run through my option profits real quick. This again, there was over $1.8 million in profits in option purchases, and average return of 85%, 183 wins, 17 losers, so just over 90% accuracy. This is actually a TradeMONSTER account here. Had an average return in this account of 198%. So I'll just run, here's in this portfolio, this snapshot, I had $254,000 in profits and average return of 114%, and $147,000 in profits in this account, $341,000 in these two accounts, and again, this totaled up to about $1.8 million in profits for the option purchase strategy, using our technical and fundamental analysis. Okay, so that concludes today's presentation on, we recapped the covered call strategy, and we went into some detail on the super portfolio. And in my weekly option advisory, we trade covered calls, and we also have a portfolio for the super portfolio stocks. So if you want to get an updated profit performance for these portfolios, you can just log on to weeklyoptionalert.com, or you can call Brad toll free. And if you log on to the website and click trade results, we list the current profit results for these various portfolios. And the portfolios have been performing well in this type of market environment, and we just maintain our discipline each week with the covered calls. We roll those over every week, and it's been working out real well with us. And the super portfolio has also been performing very well. So I'd be glad to take any questions at this point that you might have concerning the covered calls or super portfolio.
One question, Chuck. Do you ever use leaps for covered calls?
Yes. Yes. Question is, do I use leaps options? And that first example that I showed you, where I bought the small cap ETF at a 30% discount to its current price, that was a leaps option. So you can get some really fat premiums with those leaps options. And you saw with that trade example that if that ETF remains flat at option expiration, I was going to realize over a 42% return, even if the ETF was flat. So think about that for a second. In this type of market environment, if the stock is flat or the ETF is flat, and you're going to collect a 42% return, that's a huge advantage over, probably most other strategies. And again, that was using a leaps option. So the large premium with that leaps option enabled me to get those kind of results where if the ETF was flat, I still get a 42% return. If it's down 20%, I still got a 14% return. So that was an example of using a leaps option for these covered calls.
Another question for you from John Laney. He's asking, with all the stuff that's going on, the geopolitical concerns, the Washington deficit cliff, sequestration, worries, do any of these affect your trades, or do you bypass this, Chuck, stick with your discipline and stick with domestic companies that don't have overseas exposure?
Yes, that's a great question, because in this current market environment, it's really difficult to predict where the market's going. And a lot of times, the market won't go in the way you thought it was going to go based on the macroeconomic picture with this sequestration. For example, even though it looks like this sequestration is going to definitely happen, the defense stocks have been making new highs, and they're going to be one of the hardest hit groups in the sequestration. So it's really hard to predict where any stock is going to go in the future. So I just maintain my discipline, and if you can get 130% cash-on-cash return over the course of a year with these weekly covered calls, then you're way ahead of the game, and you don't even have to be concerned with these daily and monthly geopolitical issues and sequestration and the fiscal cliff and the European debt crisis. So I just maintain my discipline, and that's enabled us to do very well. So I just found it's very hard to predict where any trend is going, and so I simply follow my indicators, and that's kept me out of trouble, and it's done very well regardless of what the market condition is. So we like to just stick to our systems and our indicators. We just follow it along, and I really don't pay that much attention to what I think the market's going to do based on the macro economic picture, because it's just really hard to predict what's going to happen.
Last question for you, Chuck, before we let you go. Some of the clients are commenting that they notice that you do a lot of these covered calls in the super portfolio and the IRA. By nature, they're a little more conservative. Do you tend to speculate with your option spreads and your naked options in individual accounts or non-IRAs, or is just kind of how it is, or is that a method to your madness?
The option spreads, of course, most retirement accounts you cannot trade option spreads. So those would have to be done in a regular individual or joint brokerage account. Of course, the super portfolio and the covered calls can be traded in most retirement accounts. So they're considered lower risk. And option purchases also, a lot of times you can do those in retirement accounts. So if you're looking at using your retirement funds, you can certainly buy the super portfolio stocks, and you can do covered calls in almost any retirement account. And then with some brokerage houses, you can do the option purchase. But the option spreads, for the most part, have to be done in a non-retirement account.
Great. Again, as usual, Chuck, thank you very much for taking the time to do that. For those of you that are with us, Chuck is actually going to send out a stock market magic book, which he authored, and covers some various strategies as well. Chuck has been kind enough to allow us to keep some of his past posts and webinars up on the website. And due to that, Chuck, we appreciate you doing that, because clients are always going back and downloading and playing the particular webinar that you covered a specific strategy, whether it's a covered call or an option spread, and we get a lot of feedback from that. So I just posted on the screen, Chuck went over back in September 2011 here, you could see it, his stock selection process. And I know it goes in real good depth regarding some of his process and the steps that he covered today. Chuck, thank you very much for allowing us to keep those posted.
Oh, yeah, my pleasure. And thank you, Tom, for taking the time to set this up for everybody.
Yeah, we appreciate you coming. Hopefully next month you come back, Chuck, and we can cover another one of your strategies.
Yep, that sounds good. I'm working on that right now.
Okay, that sounds great. For all of you that joined us, again, you can go to mytrademonster.com. I'll have today's webinar archived tomorrow under the month of February here. Again, the first part is going to be in January. And again, I would go back to September and take a look at Chuck's two-part series, September 2011. It's loaded with great information. Otherwise, Chuck, thank you very much for the information, spending the time and the effort to do these educational webinars. We really appreciate it. The clients appreciate it, and we're getting some great feedback. So thanks again, Chuck.
Okay, thank you, Tom, and have a great day, everybody.
You as well. And everyone, if you have any questions, by all means, feel free to contact us here at MyTradeMonster. You can go to mytrademonster.com, look up various information about us, our group, our trading, some of our free education that we offer out there. Otherwise, thank you for spending the time today, and best wishes to all traders out there. And don't forget, trade like a monster. Good night, everybody.
Yeah.